Jim Keenan, is now a good time to own high yield bonds?
Now's a good time to be invested. I don't think you should be fully invested in high yield, but you should probably be somewhere around your 40 to 50% of what your max risk is going to be.
What kind of yields are you seeing right now? Because this still is a low yield environment.
Yeah, the market's around 8% today, and if you think about that, that's 8 times the yield of the 5-year Treasury. Historical average is about 2.5 times. So you have a lot of risk premium built into the market.
And what's the quality out there? Where is the default rate right now? And what are your expectations for 2012?
Yeah, in all likelihood, defaults are going to pick up, right? Because we are moving into more austerity and fiscal drag, and so 2012 is still going to be a tough year. But default rates right now are probably around 2%. They are going to pick up, but you got to look at today's spread levels. You're factoring in kind of low teens annual default rates for the next 5 years before you actually start losing money if you're going to make it an investment. So there's still a lot of room built into the market.
One of the other big determinants about the success of high yield bonds is supply and demand. Where's supply right now?
Yeah, supply, high yield issuers really kind of extend out their liabilities. They don't want to take the risk of our capital markets available for them today. So in the beginning of the year when you had the risk on and some growth story, a lot of the issuers pushed out a lot of their maturities. That's why you see today the high yield issuance is really shut down for now.
All right, what are your favorite sectors in the high yield area?
Yeah, because we're worried about kind of the more global leverage unwind and the systemic risk in the market, we're kind of looking at assets, the higher quality end of the spectrum, things that we think are great 3 to 5 year investments, right? More in the kind of 8 to 9%. We like a lot of the energy trades, natural gas, oil. We still like some of the kind of healthcare space, things that have more stable and visible cash flow streams.
And what are you avoiding on the flip side?
Yeah, on the opposite side of that, because of the lack of transparency with regards to policy and what that may move around kind of GDP, we're still looking and avoiding things that have more consumer discretionary focus to them, the things that you don't really have transparency into 2012 earnings. So without that visibility, we don't have the clarity of really trying to price out risk premiums.
And finally, what would cause you to reassess this view?
Yeah, something more concrete with regards to a policy decision. Right now, there's really a lack of transparency as you've moved a lot of debt onto sovereign balance sheets. And so now you're dealing with political leaders who are trying to make decisions, and we don't have transparency of what's going to go forward. So whether it's the U.S. Congress or the European Union, if we had transparency, whether you're going to put risk on or take risk off, either way, if you had a little bit more certainty, you'd be able to make more finite decisions.
Thanks a lot.
Great. Thanks a lot.